This is Dennis Williams, the creator of CashMap, and thanks for joining me for part 3. As we walk through this scenario of paying off a $375,000 mortgage and the underlying principles of keeping your dollars working 24/7 to accelerate generating wealth. So again, just a quick overview of our scenario, a $375,000 mortgage. We're looking at a little over $6,900 of income being deposited every month, $6,400 in monthly expenses, and roughly a $500 positive cash flow, and lastly, $10,000 in savings. So, over 30 years, this loan, you're going to be making $684,000 in payments. Just the interest will be roughly $309,000. Additional payments, as we saw in part 2, shorten the loan's life. If you do nothing and follow the schedule, the loan will be paid off at the halfway point at 19.75 years. Now, the core of our scenario, being able to keep your dollars working, is the average daily balance. And what is this? It's what the banks and financial institutions use to pay us on savings accounts as well as charges interest. If you're in Canada or Britain or Australia, they may be using what's called the daily interest charge. The principle is exactly the same. We're not taught about it. We're not taught its implications. This is also true where CPAs, MBAs, bankers are not taught the implications of managing your average daily balance. So if you decide to go visit your banker, they will not know what you're talking about. It is calculated by adding the sum of each day's balance in either a line of credit or savings account and then dividing it by the number of days in the month. So the goal is to optimize the average daily balance, whether it's in your savings account or if it's debt. So what you want to do is deposit your dollars early in the billing cycle and pay expenses at the end. So let's take an example. Let's start with a savings account. If we're looking at the income in our scenario, you can see they're paid on the 1st and the 5th, and they are paying their expenses roughly on the 20th of the month, and that gives them a daily average balance of $1,693, which at a 2% interest rate, that'll be a whopping $2.82 that they're going to get. Now, if they were to shift to pay their expenses to the 30th of the month, that's going to result in the average daily balance jumping to $5,045, and at 2%, now their interest they will receive is $8.41. That's 198% greater just by making that one change. So what are the implications? The greater the average daily balance in a savings account, the better. The percentage difference is big, but the dollars are small. So for most of us, what's the big deal? When managing debt, the dollar difference can be huge. With debt, instead of maximizing the average daily balance, making the exact same changes that we've done here will minimize the average daily balance. And this in turn provides us with a unique opportunity. So let's go and look at how most people use a line of credit. Most people, if they take dollars from a line of credit, and we're taking the first draw for what we're going to be doing for our scenario, they take it off and wait for the bank to charge them the following month. And it just sits there. And so the average daily balance is $2,500, and you're going to pay interest at 5% of $10.50. Now, just multiply that times 12, and you'll figure it out. Now, using our first savings scenario, in which we're paying our expenses on the 20th, what that does is by moving our income into the line of credit, and in turn, paying our expenses on the 20th, and now our average daily balance is just $1,300, and we only pay $5.52, which is 47% less, but we're not done yet. What if we were to shift all the expenses to the end of the month on the 30th? Now what that does is lowers the average daily balance to $190, which the interest cost in this first month is just 79 cents. Now, since during the middle of the month, we're actually going to end up paying off that line of credit with our income, we'll be shifting the balance over to the checking account, in which we'll be getting $3.70 at the end of that first month. Now, if we allow for our mortgage being paid on the 15th, we're actually still able to have an average daily balance of $190.77, paying 79 cents in interest, and the dollars left in our checking account are a little bit less, so we get paid $2.11. So here's our opportunity. Withdrawing $2,500 off that line of credit cost us in interest just 79 cents. Applying it to our mortgage, it's saving us $6,500 in interest expense. So using our income reduced our line of credit costs by 92.4%. We're using our income to refinance our debt. And the only item left now is that we need to know our line of credit's billing cycle. We've assumed it's on the 30th. The interest rate doesn't really matter here. At 5%, our interest cost on the line of credit was 79 cents. If it was 10%, it would be $1.59. If it was 15%, our cost now goes to $2.38. And at 20%, our interest cost now goes up to $3.18. So a low average daily balance of $190 was the key in being able to lock in these kinds of savings and making the line of credit a powerful tool to use to help us build our wealth. So, over 12 months, again, would you spend $130 to make $20,000 in principal payments? That enables you to make an additional $13,000 in principal if you did not do this. That would allow you to pay off the loan 21 months earlier, saving you roughly $27,000 in interest, building a savings balance of $14,000, and would you prefer just doing it the usual way, growing your savings to $21,000 and earning just $354 in interest at 2%? If you chose the first option, the loan's going to be paid off in 15 years. You're going to be saving about $108,000 in interest, building $86,000 in savings over 15 years. Over 29 years, that's $1.1 million. And you're using a line of credit of just $15,000 at a 5% interest rate. So to learn more, visit our website. We've got over 90 articles, an ebook, interactive resources, and consulting options. If you got other scenarios for me to look at, email me at admin@cashmapapp.com. Thank you.